Hey there, fellow investors! Let's talk tariffs, those pesky import taxes that have been shaking up the market lately. Remember when Trump first slapped tariffs on goods from China? The market went haywire. Fear gripped investors, sending stocks tumbling faster than a bull in a china shop. But hold your horses. The market is a fickle beast. Lately it seems like Trump's bark is worse than his bite. Word on the street is that these tariffs might be more targeted than initially feared. And guess what? The market loves a good rumor. We've seen some decent rallies lately, with the Dow and S&P 500 inching back up. But don't break out the champagne just yet. This whole tariff saga is far from over. Trump's known to change his mind faster than you can say trade war. One minute he's all about tariffs, the next he's buddy-buddy with world leaders. This uncertainty keeps investors on edge, making the market jumpier than a kangaroo on a trampoline. Bottom line? Keep your eyes peeled and your trading apps open, folks. This tariff roller coaster has still got a few twists and turns left. Okay folks, let's talk about the economy. And trust me, it's not all sunshine and rainbows out there. Some big flashing warning signs are telling us to brace for impact. First up, consumer confidence. Remember how I always say, the consumer is king? Well, the king is feeling a little under the weather. Consumer confidence just hit its lowest point in years. That means people are nervous about the future. And when people are nervous, they don't spend money. And that, my friends, is bad news for businesses and the stock market. Next up, the S&P 500, our trusty barometer of the stock market's health. It's been on a bit of a downward spiral lately, and whispers of a quarterly loss are sending chills down investors' spines. A quarterly loss hasn't happened in years, and it's a sure sign that things might be heading south. And let's not forget about Uncle Sam's ever-growing debt problem. The national debt is skyrocketing, and that's putting a serious strain on our country's financial health. It's like maxing out your credit card and then hoping for a miracle to pay it off. Spoiler alert, miracles are in short supply these days. Bottom line, the economy is sending out some seriously mixed signals. It's like a game of economic roulette, and right now the odds aren't exactly in our favor. Alright, I know what you're thinking, Jim, this all sounds terrible. Should I just bury my money in the backyard and hope for the best? Hold on a second. Before you start digging, let me tell you about a little something called ETFs, specifically VOO. ETFs, or exchange-traded funds, are like the diversified superheroes of the investing world. They offer a basket of stocks which spreads your risk and protects you from the ups and downs of individual companies. Think of it like this. Instead of putting all your eggs in one basket, risky, you're spreading them out across multiple baskets, much safer. Now, let me introduce you to VOO, the king of the ETFs. VOO tracks the S&P 500, which means you're investing in 500 of the largest, most established companies in the US. It's like owning a tiny piece of the entire American economy. Why VOO, you ask? Simple, it's like a rock in a storm. When the market is going crazy with tariff worries and economic jitters, VOO provides stability and long-term growth potential. It's the investing equivalent of a warm blanket and a cup of hot cocoa on a cold winter's night. Bottom line, don't let market volatility scare you away from investing. ETFs like VOO are your secret weapon for weathering the storm and coming out stronger on the other side. Section 4. ETFs versus mutual funds. Why ETFs win in today's market. Now you might be thinking, Jim, what about those mutual funds my grandpappy always raves about? Well, while mutual funds have their place, ETFs are like the younger, cooler sibling who's taking the investing world by storm. First off, ETFs are cheaper than mutual funds. We're talking about lower expense ratios, which means more money in your pocket. And who doesn't love keeping more of their hard-earned cash? Second, ETFs are more tax efficient than mutual funds. Without getting bogged down in the nitty-gritty details, let's just say that ETFs are structured in a way that minimizes your tax burden. And trust me, when it comes to taxes, less is always more. Third, ETFs offer more flexibility than mutual funds. You can trade ETFs throughout the day, just like individual stocks. Mutual funds, on the other hand, can only be bought or sold at the end of the trading day. So if you're looking for more control and agility in your portfolio, ETFs are the way to go. Bottom line, when it comes to ETFs versus mutual funds, ETFs are the clear winner in today's market. They're cheaper, more tax efficient, and offer greater flexibility. So ditch the old school mutual funds and hop on the ETF bandwagon. Section 5. The magic of compounding. Watch your money grow while you sleep. Now let's talk about the real secret sauce of investing: compounding. Compounding is like the eighth wonder of the world, the financial gift that keeps on giving. It's how your money makes more money, even when you're sleeping, eating, or watching your favorite CNBC shows. Here's how it works. When you invest in an ETF like VOO, you're not just buying shares of companies, you're also buying the potential for those companies to grow and pay dividends. Dividends are like little bonus payments that companies give to their shareholders. Now here's where the magic happens. When you reinvest those dividends back into your ETF, you buy even more shares. And those shares generate even more dividends, which you can then reinvest to buy even more shares. It's a beautiful cycle of growth that snowballs over time, turning your initial investment into a financial avalanche. Bottom line, compounding is the key to building long-term wealth. The earlier you start investing and reinvesting your dividends, the more time your money has to grow exponentially. So don't delay, start investing in ETFs like VOO today and let the magic of compounding work its wonders. Section 6. Beyond VOO, other market movers making headlines. Now while VOO is a fantastic core holding for any portfolio, let's not forget about the rest of the market. There are always exciting things happening in the world of stocks, and it's important to stay informed about the companies and trends shaping the future. First up, Apple, the tech giant that needs no introduction. Apple's stock has been on a tear lately, and for good reason. They just can't seem to stop innovating and releasing must-have products. From the latest iPhone to their growing services business, Apple is a money-making machine. Next we have Tesla, the electric vehicle pioneer led by the enigmatic Elon Musk. Tesla's stock is known for its wild swings, but investors are betting big on the company's potential to revolutionize the automotive industry. With sleek designs, cutting-edge technology, and a growing network of charging stations, Tesla is a force to be reckoned with. On the flip side, we have companies like NVIDIA and CrowdStrike. NVIDIA is a leading provider of graphics processing units, which are essential for everything from gaming to artificial intelligence. CrowdStrike is a cybersecurity firm that helps businesses protect themselves from cyber attacks. Both companies are at the forefront of rapidly growing industries, making them exciting investment opportunities. Bottom line, while VOO provides a solid foundation for your portfolio, don't be afraid to explore other market sectors and invest in companies that align with your investment goals and risk tolerance. Section 7. Stay informed, stay invested. Navigate market volatility like a pro. The market can be unpredictable, but you can navigate volatility and come out ahead. Stay informed by reading financial news and following experts. Don't panic during short-term fluctuations. Diversify your portfolio with stocks, bonds, and alternative investments. Stay invested to let your money grow and compound over time. Remember, the biggest mistake is sitting on the sidelines. Now go out there and make some money.